Hey there, fellow traders. Welcome back to our YouTube channel. Are you tired of the endless hustle in the Forex market, trying to figure out when to scalp your trades and when to hold on for dear life? Well, buckle up because today, I've got a game-changing strategy that's not only simple but could potentially bank you $100 every single day. So, grab your coffee, clear your charts, and let's dive into the ultimate Forex playbook that could change your trading game forever. See you after the intro. Let's start by understanding market structure. As the price moves up in an uptrend, it breaks above previous highs. The last low that took out this high becomes our swing low. As long as the price is trading above this swing low, we're still in an uptrend and on the lookout for buying opportunities. However, even though the market sentiment is bullish, it doesn't always mean that the price will shoot straight up. Instead, the market moves in waves, with impulsive movements and pullbacks. We're particularly interested in these pullbacks because they help us predict when they'll likely end before the price resumes its upward movement. Knowing this, we can time our entry into buy positions in the market. So, how do we accurately predict the end of a pullback? Well, in every pullback, the price will likely retrace within the 0 to 50% Fibonacci retracement zone, also known as the discount pricing. In an uptrend, this is where we should always look to buy. Within this range, we identify our point of interest. What's a point of interest? In the concept of smart money, it can be an order block or fair value gap. We won't delve much into these in this video. We then place our buy orders and wait for price to push higher, breaking above our swing high. This becomes our new swing low, and as long as the price is trading above it, we're still in an uptrend. We then identify our point of interest again and wait for the price to retest it. Once more, we place buy orders, and the price pushes higher, breaking above our swing high. This creates a new swing low, and as long as the price is trading above it, we're still in an uptrend. These patterns repeat in the market, continuing until the market loses momentum and breaks below our swing low. This is what traders refer to as a change in market character, indicating a trend reversal. We then start looking for selling opportunities from this point. That's the essence of market structure, but it doesn't end here. First, let's take a look at an example on a price chart. In this price chart example, we can observe clear breaks of structure to the downside, leaving behind distinct points of interest from which we can initiate selling positions. Seems straightforward, right? The catch here is that the average time between each setup is roughly a month. Waiting that long for just one setup isn't practical. This brings us back to market structure. When we zoom in on these pullbacks, we can identify clear lower timeframe downtrends that also respect price action as much as the higher timeframe does. This means that with the correct use of multi-timeframe analysis, we can capitalize on these short-term selling positions. So, when we switch from a higher timeframe to a lower timeframe, we'll see something like this. Earlier in this video, we mentioned placing buy orders at these points. But now, knowing that these pullbacks consist of short-term downtrends that also adhere to price action, we can also seek short-term selling opportunities. When applied correctly, this strategy ensures we have multiple setups in a short period of time, catering to both short-term and long-term trading perspectives. While it may seem simple as I explain it, many people struggle to apply this strategy correctly on a real price chart. That's precisely what we'll address today. Step 1. When analyzing the market, always begin with a higher time frame, such as the weekly, daily, or 4-hour time frame, depending on your trading style. On this time frame, focus on two aspects. First, determine the directional bias of the market, which in this case is bullish. Secondly, identify key demand zones where you anticipate buying opportunities if the market retraces to them. From this higher timeframe perspective, it's likely that the price will retrace to retest our demand zone. Meaning that as price is going down, we can capitalize on short-term selling opportunities within this retracement. Let's switch to a lower timeframe to detect any change of character in the current price. On the lower timeframe, wait for the price to break below the recent low. Once this occurs, it signifies the beginning of the retracement, and you can start looking for selling opportunities as the price declines. However, before entering any sell positions, let's delve into a crucial concept that many traders often overlook. Now that we have a swing high, let's apply the Fibonacci retracement tool from the swing low to the swing high. It's essential to understand that we only sell at supply zones within the premium range. I repeat, we only sell at supply zones that are within the premium range. Once your supply zone is within the discount range, refrain from initiating sell positions from that area. Remember, As mentioned earlier, at the discount range, most traders are seeking long-term buying opportunities, so, selling within the discount range contradicts the prevailing buying sentiment of the market, increasing the likelihood of losing that trade. As the price descends, it presents multiple selling opportunities. The first two are within the premium price, making them safe to sell from. However, the last zone, located at the discount price range, carries significant risk, and you should never sell from zones within this range. Once the price retests our higher timeframe demand zone, it indicates the end of the retracement. At this point, we stop looking for selling opportunities and place long-term buy orders, targeting above the swing high. Upon hitting the take profit, repeat these 3 steps again and again, until there's a change of character in the higher timeframe structure, signaling the start of a downtrend. Apply the same 3 steps in the downtrend scenario. Before we dive into price chart examples, it's crucial to highlight that in a downtrend, during the retracement phase, we look to buy in demand zones that fall within the discount pricing. Let's apply all these steps to the price chart example, starting from the higher timeframe. Here, we only focus on 2 aspects. First, the directional bias of the market, which is bearish in this case, and second, key supply zones from which we can sell from should the market retest them. It's important to note that we don't consider this particular zone as a supply zone to sell from because it acts as an inducement. When you have 2 supply zones stacked on top of one another, the first one acts as a liquidity trap. Price will push through it to retest the supply zone at the extreme. From this higher timeframe perspective, it's very likely that price will retrace back to retest our supply zone. Let's transition to a much lower timeframe to identify any change in market character in the current price. For a change in market character, we patiently wait for the price to surpass this high. As the market unfolds and the price breaks above, we now have a valid change in structure, signaling the potential for short-term buying opportunities. However, it's crucial to remember that in a downtrend, we seek to buy at demand zones positioned within the discount range. Next, we pinpoint a clear demand zone situated within the discount pricing. We patiently await the price to pull back and retest it. Subsequently, we place our buy orders, with a stop-loss position below the demand zone and take profit set above this high. Then, it's a waiting game. The market unfolds as expected, breaking above the high and reaching our target. To continue capitalizing on this retracement, we identify another demand zone within the discount pricing. Again, we patiently wait for the market to pull back and retest this zone. Once confirmed, we place another buy order, with a stop loss placed below our demand zone and take profit set above this high. As anticipated, the market plays out, breaking above the previous high and reaching our targets once more. Additionally, price retested our higher timeframe supply zone, meaning that this retracement is over. We then shift our focus from short-term buying opportunities to long-term selling opportunities. Let's transition back to our higher timeframe to accurately set our take profit target. In this higher timeframe, we strategically place our long-term sell orders, setting our stop loss above the supply zone and take profit below our swing low. Then, we patiently wait for the price action to unfold. As expected, the price plays out and reaches our take profit target. Additionally, we observe a break below our swing low, indicating that the directional bias of this market remains bullish. Since we are still in a downtrend, let's reapply the same steps on this price chart. Zooming in, we pinpoint our higher timeframe supply zone. From this perspective, it's highly probable that the price will retrace back to retest our supply zone, presenting us with another opportunity for a long-term selling position. Let's transition to a lower timeframe to identify any changes in market structure within the current price. In this lower timeframe perspective, we wait for the price to break above this high for a valid change of structure. Some traders might mistakenly consider a break above this high as a valid change of structure, but it's important to note that this high failed to take out the swing low. With this condition in place, we cannot deem it as a valid change in market character. After patiently waiting, the price finally broke above, signaling the start of the retracement. But before we begin seeking short-term buying opportunities, it's crucial to recall that we buy in demand zones within the discount pricing. We then identify a demand zone within the discount pricing and wait for the price to retest it. Once confirmed, we place buy orders with a stop-loss position below the demand zone and take profit set above this high. After some waiting, the price pushed up and reached our target, also breaking above the previous high. Subsequently, we identified another demand zone within the discount pricing, but in this case, the price failed to retest our demand zone by a few inches. This is part of trading. Sometimes, you will miss trades. Price retested our higher timeframe supply zone, indicating the end of the retracement. We shift our focus to long-term selling opportunities. Let's transition back to the higher timeframe to set our take profit targets. Here, we place our sell orders, setting the stop loss above the supply zone and take profit below this swing low. Then, we patiently wait for the price action to unfold. As expected, our targets were reached. And there you have it. With this simple strategy, when applied correctly, you can capitalize significantly on the market. Take the time to go through this video repeatedly until you grasp the concepts discussed here. Don't forget to like and subscribe to the channel to stay updated on future uploads. See you in the next video.